You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
If it's Saturday, must be a real money day. Hi, everybody. I'm Don McDonald. Thanks for stopping in. I am glad you're there. I'm sure other members of the audience will be glad you're there. And we want to talk about life, but a specific part of life. That would be the financial part, the money issues, the crazy things that drive you crazy when you're dealing with money, particularly the growing of it, the investing of it, the building of wealth, the generating income in retirement. All of these kinds of things make people crazy. So that's why you need a show, a place you can go to get questions answered, to get some insight into the reality of managing money. And that's why this show exists. Again, I'm Don McDonald. Tom Cock, my partner, on vacation, doing his annual sojourn to lovely Lake Chelan, where I think he said it was 105 degrees yesterday. That's like Florida weather, except without the humidity. So he's having fun, I'm sure, and we're going to have fun here. Or at least get educated. Hopefully you get entertained. 855-935-TALK is our phone number here. That's really, really easy to use. You can call me and we can talk live on the show. Or if you want to wait until after the show, you can call and leave your questions at that same number 24 hours a day, 7 days a week. 855-935-TALK. See, we're always there for you. So give us a call. 855-935-8255. Love to help. That's my primary purpose in life, I've determined. I determined that about 35 years ago when I started doing talk radio. That's my job. Sit and talk to you. I love doing it. So call me, 855-935-8255. It has been a weird week. Financially, it's been a weird week. It's been a weird year. Financially and otherwise. This really has. 2020 is one of those years that we'll look back on it and go, that was just a weird year. That was not normal. There was nothing normal about it. But last week was a bit abnormal too. And we alluded to this in a podcast last week, but it bears repeating. You have to be a little bit careful about the reports you hear in the media. And I'm referring specifically to the report about gross domestic product last week. This was misleading. It was. The reporting was misleading. And I think pretty much everybody in the news media was guilty of it. It was sensationalistic. And I don't care. It has nothing to do with politics. It was just designed to get people to listen and watch and read. The reports that gross domestic product dropped by a third. So, wait. Did the value of the U.S. economy drop by 1/3? Did we lose a third of our productivity in one brief report for a quarter of economic activity? No. You see, there are lies, there are damned lies, and there are twisted statistics. This was a twisted statistic, because if you read further, then the article probably said, or hopefully the announcer said, that the gross domestic product of the United States declined by 32.9% if annualized, or they will just say annualized. Well, even just saying annualized is slightly misleading because most people don't know what the heck that means. What do you mean annualized? Here's what they should have said. You want the honest answer, the correct wording? U.S. gross domestic product declined by 9.5% in the second quarter. That's right. Gross domestic product did not decline by 32.9%. It declined by 9.5%. Now, if you multiply 9.5 by 4, let's go ahead and do the math. What do you come up with? About 39%. It's a little over 9.5, 9.6, 9.7. So the reports were misleading. Actually, it's 38. The reports were misleading. Oh, that's right. They combined the first and the second to come up with that annualized number. But the reality is the U.S. economy didn't lose a third of its value, and the third quarter has seen things perking up a little bit. Yes, 2020 is going to be a terrible year for the economy. But again, that does not translate directly into your investments, and that's one of the things we need to talk about. You can call and get the straight scoop at 855-935-TALK.
Tom and Don are talking real money.
You've heard that about 99% of all financial advisors are not always required to act in your best interest. You've probably been pitched financial products by all manner of friends and relatives, and the investing you have done is probably a hodgepodge of ill-fitting pieces that are doing little to provide the financial security you need. If you're looking for a 100% pure fiduciary, and we'll put that in writing, low-cost, fee-only advisor who always puts you first, give Vestory a call at 800-386-3004. That's 800-386-3004, or visit us online at Vestory, VESTORY.com.
For your real life and real future, Tom and Don are talking real money.
This Saturday, just Don, no Tom. I'm Don McDonald. Call me at 855-935-TALK, 855-935-8255. And let's talk about your financial situation. What are you doing with your money? What should you be doing with your money? What are people trying to sell you? How are you set for retirement? What will you do in retirement? Do you need that insurance? Should you buy that annuity? Are you paying more than you should? Call 855-935-8255. Before the break, I was talking a little bit about the GDP numbers. And I've been reading a lot online, particularly from millennial bloggers who don't get it. They're actually incensed that the stock market did not go down with the terrible report on GDP. It was almost insulting. You know why? Because they expected that it would. You see, they're looking for an immediate cause and effect. As many of you are, you're looking for a direct connection between the economy and the stock market so that you can go, all right, something bad happened, I can sell now. Or something good happened, I can buy now. You're missing the realities of the market. You need to understand this. This is really, really important. This is one of those big picture things that can make a big difference in how you invest. Stock investors in aggregate, there are millions of them, in aggregate, are looking forward not just a day or a week or a month or even a year. They're looking forward years and years and years, and they're building into the price of stocks the earning potential of that stock for years to come, because the majority of stock investors, as opposed to speculators, timers, players, they're there for the long run. They're buying a company for its future earnings and its future earnings growth potential. So they're looking way beyond COVID-19. COVID-19, they know that this is a temporary event. It may have some long-term implications, but they will be merely implications. When, not if, when there is a vaccine, this, like every other disease that has plagued humanity, will be in the rearview mirror, and we will mostly forget it. just as people of our parents' generation, for the most part, didn't dwell on the 1918 flu pandemic or the pandemic that we had in, I can't remember when it was, 80s sometime. These things happen. It's part of being a living creature on the planet. There are going to be diseases. We'll deal with it. But the economy, you see, the economy is bigger than that. The economy is bigger than any one issue that affects humanity. Because if the economy was easily destroyed by events, then there were bigger things in the past that should have destroyed it. So expecting cause and effect, direct relation cause and effect, is naive. It's wrong. It won't work. And it's why so many people make such bad investing decisions. Because they believe there is a direct cause and effect. When something happens, then something else should happen. That's just normal. When something bad happens, there should be a reaction. But if the bad has already been built in, then there shouldn't be a reaction. If this virus suddenly mutates and turns out to, kills 10 million people in the course of 6 months and shuts down the global economy for, almost completely, then that will affect the stock market because that will be a surprise. You see, surprises, they have immediate impact. The fact that this went from one guy in Seattle with this bad disease to spreading nationwide in no time at all is what sent the market plunging in March. That was because it was surprised. The stock market does not like surprises. And, by the way, surprises happen. But by their very nature, it's not like the surprise party that leaks to you the birthday boy or girl. No, surprises are, by their very nature, unknown and generally unknowable with any degree of certainty. You can plan for them, but you can't know them. Therefore, you can't react to them because it's going to be too late. You are not going to be the first one to get the news that something bad that no one expected is happening. You're going to be one of the last to know. So by the time you trade, well, it's too darn late. So, what do you need to do? It's actually incredibly simple. It really is. And that's what we don't like about it. I think you don't like this answer because it's too simple. It's too simplistic. Well, it must be more complicated than that, Don. Gee whiz. Don't we have to do something highly sophisticated that's costly? No. You have to do something incredibly simple that's emotionally difficult. This is the part. It's emotionally difficult to do this. What you have to do is determine two very important things about your future. One, how much risk do you need to take to get to where you need to be in the future? That's a math problem. Determine how much you need. Work backward from there. Then, how much risk can you tolerate? And by risk, I don't mean risk of losing everything, because I do not believe that short of an asteroid hitting the Earth, there's any chance you can lose all your money in a diversified portfolio of stocks and bonds. I don't believe it's possible. So therefore, the only risk you're now dealing with is the risk of volatility. Volatility, so important. Please get that in your head. Volatility is risk. Now you need to understand how much volatility you personally can tolerate before you will react emotionally and do something dumb like sell. It's gone down too far, Don. I must get out. How far can it fall? Then, again, we're just working mathematically backwards. Then go look at what a combination of diversified stocks and bonds have done in worst-case scenarios in the past. And that is likely to be similar to how they'll react in the future because we're dealing with the same makeup of investors, human beings. And build your portfolio for that. And if everybody would do that, then this show will end at this break. It would end right now, and you would never have to listen again. Good thing you won't.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Tom is vacationing, so I am here. And my number, our number, the number to call to get answers about money and investing is 855-935-TALK. 855-935-8255. You can call that 24/7 because in addition to doing the Saturday show on Como in Seattle, we also, I'll be turning this into a podcast for next Monday. And then on Wednesday, Thursday, and Friday, Tom and I do podcasts the rest of the week, and your questions will get answered on those too. But the nice thing about doing it during the show is that it's a two-way conversation. The other way, it's you asking a question and me answering it. This way, we can carry on a conversation. So give me a call, 855-935-TALK, 855-935-8255. It is so easy, and I really would love to help you get on the right track because here's the thing. I've been doing this for a long time. I've been doing a financial talk show since I was not very good at it back in 1988. I've gotten better over the years. I've been practicing. And the one thing I've determined after talking to tens of thousands of investors is that even when you think you get it, you probably don't get it. And that's not a dig. That's just reality. And that's why I think it's important that you call and get an opinion of somebody else like me. There are others out there. There aren't a lot of good ones. Matter of fact, I want to talk about one. As a matter of fact, let me do that now. I just want to, because I was actually listening to the radio in my car because I did some driving this week, which I really don't do very often. And I heard a mention, I think it was on public radio, so it was one of those sponsor things for a investment company in the Orlando area, which is where I live. And I've listened to these guys on the radio because they have a talk show and they've had it for a long time. And their ad said, we're 100% fiduciaries or something to that effect. I don't know if they used the 100, but they said, we're always your fiduciary. And so I went to their website when I got home and I read their fiduciary pledge. And it essentially says, it says, following the fiduciary pledge means that we will not accept any referral fees or compensation contingent upon the purchase or sale of a financial product. Now, wow, that says they don't take commissions, right? Well, no. Wrong. You see, there's what they say to you and on their website, and then there is what they say to the government in their Form ADV Part 2, which is one of those things that I want to try and get you guys to read. It's important. Because in that, they say that there are conflicts of interest, that representatives of their firm are registered representatives of a broker-dealer. And they say, while our firm's only compensation is received directly from you, the people who work for our firm, The people who work for our firm receive commission-based compensation in connection with the purchase of sales and sale of securities, including 12b1 fees. In addition, they're licensed as independent insurance agents, and they will earn customary commission-based compensation for selling insurance products. These practices present a conflict of interest. Wait a minute. You say you're a fiduciary all the time in one breath, and then you sell garbage like that in the next, where your people are getting commissioned? That is dishonest. It is disingenuous, and that's the problem. Most of these investment firms are kind of sort of fibbing.
Tom and Don are talking real money.
Did you know I wrote a book? Yeah, about 10 years ago, I wrote a book about investing. Financial Physics, with an F, How Money and Investing Really Work. It's a short read. It's a really easy read because, well, as you know, investing is way too easy to be this complicated. And it's been on sale for a long time at Amazon. I updated it in 2018 to a new version. But if you don't want to buy it, you can go buy it at Amazon. It's $10. But if you don't want to buy it, if you want it free, well, you can get it free two ways. One, you can get a PDF copy by going to talkingrealmoney.com/free. talkingrealmoney.com/free. If you don't put in the /free, you can't find it. The other way is if you have an iDevice, like an iPhone or an iPad or a Mac, you can go get an interactive version of the book, a special edition that I made that's actually interactive, that's got videos and motion and things going on, and that's also free. Just look for Financial Physics, FYSICS, in the Apple Bookstore or Apple Books or whatever they call it now. Or go to talkingrealmoney.com/free, talkingrealmoney.com/free. And I guarantee you'll enjoy the PDF or the iBook or your money back. Check it out, talkingrealmoney.com/free.
Reality radio for a really great future. We're talking real money.
Hi, welcome back. I'm Don. This is Talking Real Money, and Tom is on vacation. You are invited, though, to come over and talk to me anytime during the show, or any other time for that matter, at 855-935-TALK. 855-935-8255. Anyway, the moral of the previous segment, you need to check these people out. You really do. And if you don't know how, call me. I'll help you check them out. 855-935-8255. Call now. And Ralph, you're up. Welcome to the show.
Yeah, greetings. Dawn, do you miss Tom?
Do I miss Tom? Of course I miss Tom because I know he's listening to this right now.
Oh, very good. Outstanding. Yeah, even though he's having a...
Yeah.
Oh, I imagine. Yeah, it really is.
Yeah. No, actually, he's out. He's probably out on the water listening to this on his iPhone. So, he's having a good time.
Yeah, I just hope he can swim. Okay, two-part question.
Yes.
Number one is politics. Politics.
Uh-huh.
If the individual that's president right now wins, is that going to change anything? If the other man that's not there yet, if he wins, will this do anything to the stock market for a short time?
Yeah, Tom, by the way, just responded. So, yeah, he is listening. Will it do anything to the stock market? No, I don't believe it will. And here's why. Because the stock market has anticipated or is anticipating the result. And if the result changes dramatically, there might be some change, but it won't be dramatic because here's the reality. As much as we like to talk about presidents having power to change the economy, they really don't. The good economy that preceded the COVID crisis was not Donald Trump's economy. Economies move cyclically, and a president really doesn't have much power over it one way or another. Short term, they have a little bit of power over monetary policy. But really, it's a much, much bigger thing than any politician, any party, any government entity. It's much bigger than even the Congress, which is actually more powerful financially than the president. So politically, I don't think you'll see a hill of beans of difference either way. I mean, economically.
Your DFA funds, I get Morningstar reports every month.
Mm-hmm.
And why is it most of your DFA funds, they have 10 DFA funds that they represent there of the 500 funds that they look at in Morningstar.
Uh-huh.
Why is it that all 10 of the, I just looked here before I called you.
Yeah.
Why is it that all the 10 DF funds that they evaluate, why are they're not doing very well?
Well, here, let me ask you a question that will help answer that question. Do you prefer buying things after they've gone way up or when they're down a little bit more?
Well, it's actually better when they're going down.
Right. Here's the thing about DFA funds. DFA funds do something that is not done by most mutual funds, and that is they invest in all manner of assets, including and particularly those that are out of favor, like value stocks and international and emerging markets. And if you were wanting to buy right now, would you buy the big tech stocks that have just kicked right through the roof, or would you want to buy those areas that weren't doing as well but have done better in the past?
Out of favor.
Right. You can't look back. Morningstar has a nasty habit, and I love Morningstar's data. I've always hated their ratings because their ratings look back at the very near past, and that's not indicative of a darn thing. What is indicative of potential is a 20-year track record. And let me just give you a great example. The S&P 500 over the past 10 years has been extraordinary over the past 10 years. The Standard & Poor's 500, U.S. stocks, mostly big companies. Whereas a DFA global portfolio has done half as well. But 10 years ago, when the S&P 500 was in the tank for a full decade, the DFA globally diversified portfolio returned huge amounts to investors. You got to give them time. And that's why we like them, because it's all based on science. It's not based on playing the what is hot, what is not game. All right. Thanks for the call, Ralph. I appreciate it. 855-935-TALK. That's our phone number, 855-935-8255. You got to decide. Do you want to be following all the time, which is how most investors get into trouble long term? Or do you want to lead and sometimes appear to be lagging to get the returns of the entire market, which over decades have been better than any one sector?
Tom and Don are talking real money.
We don't believe in seat-of-your-pants investing. We believe investing should be based on solid science, on academic research. That's why on July 29th, we'll be hosting a brand new class, The New Science of Real Investing, at 8 a.m. via Zoom. Get your tickets right now at talkingrealmoney.com. Just click on the new events button or the events button and reserve your place. Go to talkingrealmoney.com and make sure you're there to learn the science of real investing in our next online Zoom class. Go to talkingrealmoney.com, click on the events button.
For your real life and real future, Tom and Don are talking real money.
And let's do it together. Let's talk about your life and your real money issues at 855-935-TALK, 855-935-8255. I'm Don. Tom's on vacation, and Aaron's waiting on the line. Hi, Aaron. Welcome to Talking Real Money.
Hi, Don.
Hey, what's up?
I'm trying to decide, make a decision about an annuity.
Okay.
So
Tell me all about it.
Annuity. I'm 7 years into it. It's Allianz 360 fixed index.
Oh. I'm sorry.
Geez, that sounds terrible.
Yeah. Hold on. Let me pull up. See if I can still pull up a prospectus on that thing. Hold on. 360. Yeah. So it's an equity indexed annuity. Yeah. Yep. Don't like them. Don't like them. How low's your surrender right now?
3.75%.
Do you see that?
Which is about...
Doesn't that strike you as appalling? You've been in it for 7 years, and yet it's still going to cost you almost 4% to get out. Do you know why?
No.
Because the person who sold it to you made about a 9% commission. See why I dislike them so much?
And?
That's obscene. And my guess is you have made no more than about 3 to 4% per year on this.
That's correct.
How did I know that?
$50,000 annuity. I don't know. Because you're the man.
Because these people lie. They told you when you bought it, I'm sure of it because I've been to their sales pitches, that you would get the return of the market without any risk, right?
Right.
Do you know what the market's returned over the past 7 years?
A lot more than 3 to 4%.
You got it. So they lied. They just flat out lie to people. And Aaron, it's so frustrating when I'm sitting here every week trying to tell people the truth and have people get away with these bald-faced lies. And that's exactly what it is. So if I had this annuity, at this point, it's too late to get back the ridiculous amount of money you paid them. But it depends on what your purposes are for this money. What do you want it to do, whatever's left of it going forward?
Well, I also have a Vanguard IRA, which I take $500 a month out of, and it's pretty much holding steady over the years. It hasn't decreased.
What's it
really
invested in?
What's the Vanguard invested in?
Yeah.
I'm allowing them to manage it.
Oh! It's Vanguard doing it in their advisory service. Okay, well then, I got to tell you, Aaron, if I had this indexed annuity, and this is me, I would take the hit because you're not going to make much. I would give it to Vanguard because you're probably going to make more long term.
Yeah. So even though it's going to mature in 3 years,
it's not really maturing in 3 years. But let's think about this. If you're making 5 or 6% per year with Vanguard, which is likely with a well balanced portfolio, then whatever you pay them to get out of it, you're going to make up over there, and maybe even a little more.
Yeah.
But it's very likely to be a wash. I mean, you could stick with it. You've already paid the price. Your insurance agent who sold it to you just, they made a nice payment on a classy car of some sort. You got taken. But you know what? I got to tell you, I appreciate you calling, because you calling and letting others listen to what you got into is going to help keep several people from falling for this pitch in the future. And that's a huge service, I think, on your part. Yet for you, it's probably a wash at this point. It really is. I'm telling you, I would just be angry, so I'd get out. But it's probably close to a wash. Although you have greater potential at Vanguard, you also have risk that you don't have with this Allianz product, because they're at least going to give you nothing. They're at least going to give you nothing.
Yeah. Right. So would I be able to roll it over to Vanguard without?
Well, no, because it's probably
paying taxes?
Well, no, because it's probably not in an IRA. I hope it's not in an IRA, is it?
No.
Okay, yeah, no. You would have to pay taxes on anything earned, but then you could move it into a brokerage account with them, or you could use it to fund future IRA contributions if you're eligible.
So no matter what the point of the annuity maturity is, I'm still going to pay taxes. I can't just roll it over.
No, sir, you can't. Not into an IRA. Okay. No, it's not a qualified plan.
Okay.
Okay.
All right. Real good.
Aaron, thanks for sharing your story. I really, truly appreciate it. Thank you for calling. 855-935-TALK. That's our phone number, 855-935-8255. Object lesson. I got to tell you, I don't hate a lot of people, but I hate those who sell these indexed annuities. I really do. because they know they're lying when they tell you you can get the return of the market with no risk. Unless they're totally stupid, which, by the way, maybe a few of them are, they know that they're not giving you that. They know that there's a huge commission for them in selling these things. And yet, I know, because I've asked the question of several of them, when asked, what's the commission on this product? I have been told every single time, oh, there's no commission. The company pays me. The reason they can say that is because on your statement, there is no 8 or 9% reduction in the value. It's a game. It's a gimmick. However, if you went to them a week after you bought it and said, I would love to get my $100,000 out right now, they would say, oh, I'm sorry. You can only have $90,000 back. What? I thought I couldn't lose money. Oh no, you're not losing money. Then why am I only getting $90,000 back? Well, because there's a surrender charge. Well, why is there a surrender charge? Well, that's to keep you invested. Because this is supposed to be a long-term investment. So this is to discourage you from getting out of it early. Baloney. Baloney. Baloney made from bull. That is not the reason. The reason is they paid a big commission to the people who sold you the product, and they don't want you getting out until they recover the big fat commission that they sold to the people who were selling you the product. And indexed annuities are so convoluted, so complicated, so confusing that it is a rare insurance expert who can explain every aspect of the policy to you without reading it in great detail and then maybe reading it again. So let me just tell you, point blank, do not ever buy a fixed indexed annuity, an equity indexed annuity, an indexed annuity of any kind, ever. And if there's any doubt about it, before you buy it, call 855-935-TALK.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And by the way, in case you were curious, if you just invested in the S&P 500 over the past 7 years, you would have made about 13% per year. And if you did a 60-40 globally diversified portfolio, 60% in stocks and 40% in bonds over that same period, you would have made about 4.5%. So, either way, and that's a much more conservative portfolio. Either way, you do better than you do with these annuities, and they charge you a fortune. If you want to get some help, go to vestory.com. We can help you, and we help anybody, and there's no cost or obligation.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?